How prepared are you to make the most of the new Tax Cuts and Jobs Act? You know, it really doesn't matter how good your CPA is with a stack of receipts next April. If you haven't done the proper proactive planning, you're going to be in trouble. So I've put together some information here to help you simplify the law and make the most of it on next year's return.
So here's a big deal this year with the new tax law, is that the new tax law is effectively doubling the standard deduction. Now, how many of you, by show of hands, how many of you generally itemize your deductions or think you do? Excellent. So that's like 85% of the room. Now, when I say itemize, I'm not talking about itemizing your business expenses. Like sometimes I say to an agent, did you itemize last year? Oh yeah, sure, you know, I take my advertising, I take my auto. No. We're not talking about your business expenses. We're talking about itemized deductions like charitable contributions, real estate taxes, your mortgage interest, other miscellaneous itemized deductions. You can either take itemized or you can take standard. This year, Zillow says with the new tax law, itemizers are going to be 14% of the population. But the standard deduction is doubling, and that's why so fewer people itemize. So let's just take an example. Let's say you were married this year, filed a married filing jointly return. Your standard deduction was $12,700. The new standard deduction is double, $24,000. Now, that's not as big of a benefit as you'd think. I mean, there are some great things about the new tax law. Standard deductions are doubling. Child tax credits are doubling. And a lot of the tax rates are coming down. So if you're used to paying 35 or 30, this year you're going to pay maybe 31 or 27. So, you know, of all the returns I did this year, only 2 people did we project are actually going to pay more under the new tax law. Most of my clients are going to save anywhere from $1,000 to $3,000 on average if they took this year's numbers and, you know, run them under 2018 tax law rules. So it's doubling, but here's the bad news. The bad news is they're taking away exemptions.
Let's see how these numbers work out for a family of 4. Let's say you're in real estate, you're married, you have 2 children and a golden retriever. And no, you can't take an exemption for the dog. In fact, you can't take an exemption for your children or for you or your spouse this year. Those are some of the changes in the new tax law. Let's say in 2017, you as a real estate agent had a net income of $50,000 and your spouse also earned $50,000. That's a combined adjusted gross income of $100,000. And let's further assume that you had $12,000 in mortgage interest and $12,000 in state and local taxes, which might include your real estate taxes, your state income tax, and property tax or car tax in some states. That would add up to $24,000 in itemized deductions. You would have had 4 personal exemptions, 1 for each member of your family, you, your spouse, and your 2 children. Your taxable income would have been $59,800. You would have received 2 tax credits for children of $1,000 each. Your total tax would have been a little over $6,000. Look what happens in 2018. In 2018, you have a cap on the amount of state and local taxes that you can deduct. One of the changes in the tax law this year is you can no longer deduct over $10,000 of state and local taxes. So you lose a couple $1,000s of deductions there. And you lose all the personal exemptions. That leaves $76,000 of taxable income. This sounds bad, but look how they made up for it. You have now double the child tax credits that you had had before. So instead of $1,000 per child, you now have $2,000 per child. And in that case, that's $4,000 of a child tax credit. That's a credit that goes right against your tax. It's a dollar for dollar reduction in tax. Your total tax is only $4,700 in 2018. So really, you didn't do anything to accomplish this. The tax law did it for you. It gave you a little bigger tax credits for your children, and it lowered your tax rate, and that's a big deal. Your tax rates will actually go down in 2018. So we're off to a good start. With the new tax law, everyone will benefit from these new deductions that double and the new child tax credit that doubles. But if you don't have children, you don't have double the child tax credit. And there's other problems that may come up down the road because your income from your real estate business is going to become what's called qualified business income. That's new, and we'll cover that in more detail in another video. I trust you have found this overview helpful. If it did, please subscribe to my YouTube channel so you can stay up to date with new updates that I will post as the IRS gives further guidance on the Tax Cuts and Jobs Act. Are you 100% confident that you took advantage of every legal deduction, credit, and loophole on your 2017 return? If not, I'd be glad to review the return free of charge to see if there's any missed opportunities or mistakes and whether you can save some money by filing an amended return. If you'd like to talk further about that, you can connect with me through the website that's posted below. If you type that into your browser, it'll take you directly to my meeting calendar, and then you can directly access my calendar and schedule a day and time when we can talk by phone or in person. I'm Jim Flaus, rhymes with house. If you sell houses, don't make the mistake many agents make of overpaying on their taxes. I've got a free PDF available that will save you $3,000 on 3 tax deductions you've never heard of, plus ongoing updates on the new Tax Act. Just click the link below in the description below this YouTube video. That's it for this time. Until next time, so long.